Well, most guys I know who work in mergers and acquisitions really don't like it.
So, where do you work out?
What's up, guys? Let's talk about mergers and acquisitions. One just happened today, or at least an announcement for one of my favorite companies, Activision Blizzard, which is going to be bought by Microsoft. That's the plan, at least. So this came out today. Microsoft just made one of the largest ever bids. What they're trying to do is buy ATVI, Activision Blizzard, for $95 a share. And this deal is expected to close 2023, no later than June of 2023. Now, I've been a big fanboy of Activision Blizzard and all their IP, World of Warcraft, Warcraft, StarCraft, everything for years and years. They've been embroiled in a lot of scandal. The stock is down about 45% from its highs, along with the rest of the tech sector. But this is an interesting development, and it presents an opportunity for merger arbitrage. I made a post about this today, but I wanted to do a video on this to explain some of the reasoning, what it means, and look at some other merger arbitrage opportunities, both good and bad, that have happened in recent history. So we can really assess what the risk is on this as well as the return. So let's just draw it up here. Microsoft is going to potentially buy out the company. In other words, they're going to buy every share out there, whether you buy it in the past or you buy it now at $95 a share. You spell Microsoft. All right, so Microsoft's going to buy it for $95 a share, and we're going to look at it potentially happening before. And usually, if these things are approved, they happen before the date, but the longest they expect it to take would be June of 2023. So roughly about 18 months. Okay. So what does that mean in terms of our horizon here? Well, if we measure it from today's closing price, which is about 82.30, up to the buyout price of about 95, we're looking at close to 15 and a half, close to 16% return on this buyout opportunity. This is what you call merger arbitrage. And you may wonder, well, if they're going to buy it for $95 a share, then why is the stock not trading at $95 a share right now? It's a very good question. And that's because these things don't always go through. There's actually some reason to why the price is as it is right now versus what the later date is supposed to be. I want to look at one in very recent times. This was HRC was the stock. You can't find it anymore because the ticker is not trading anymore, but we go through and we can find some historical data. Hill-Rom Holdings was going to be purchased by Baxter, and this is a uh, healthcare equipment company. And the actual deal was, as it was going to play out, was kind of finalized on October 30th last year, 2021. And if you look here, you can see that on September 1st, we'll get this thing to come up. This is when the stock closed on that day, September the 1st, at $151.80. The final price that the shares are going to be bought out was $156. Now, look at this right here. You can see how it gets into a bit of a range here. And it actually goes lower than that price. It actually came down to 149.29. And you may be asking why? Because it hasn't been approved yet. There's always the need for regulators to approve it, make sure they're not creating a monopoly. And also the shareholders of both companies typically have to approve this deal. In this case, Activision, I believe, what does it say here? I think it did say somewhere in this article that the boards of directors had approved it. Now, what I find interesting is a sort of an aside is if you look in these months prior, there was a lot of talk about this merger going through on HRC. So there's a lot of money to be made in the run up, but in the case of Activision Blizzard, well, I saw something today when I was looking at the implied volatility and the options that suggested some people may have known, but we're not going to go into conspiracy theories. Let me look at another example here so we understand what the actual downside is. So, Rite Aid was another company that was being bought out by another company, Walgreens. This was back in 2015. I actually happened to be in this trade back then. Just happened to be, did not know it was going to play out. Let's take a look at it historically. So, one thing we have to do because they've done a 1 to 20 reverse split, a little trick here in Tradingview. We're going to divide this by 20 so we can go back and look at the shares as they were. The reason I was in this particular trade was because we got down to this level right here. Standard thing that I look for from a technical perspective. This was basically in October of 2014, around 470 a share. Boom, got into it. And then, of course, this was the announcement here. Let's just bounce back to that. Can we bounce back to that? Oh, this isn't trading anymore. So, we can't do it from that. All right, that's fine. So, here is the run up. Basically, the buyout price was supposed to be $9, and the announcement was right here on this big green bar. So if we draw a line at $9, we can see that in this period here, that is where you have that merger arbitrage going on, where they come up to a level that is not quite the level. We're going to get into that in just a second. But this is where people expected the buyout to go through. Well, what ended up happening was this was not approved by regulators. And what Walgreens had to do was actually buy certain stores. And of course, when that happened, well, the stock just tanked. And so those that would have bought into this Rite Aid deal here, well, they're in some trouble. So this is where merger arbitrage doesn't work. Let's go back to the HRC example. So when they announced the buyout of $156, it jumped up to 151.80. And I did the math on this on a new channel I created because I want to do the research. Merger Arb. When that buyout was announced, it was supposed to happen in December. Excuse me, January. It actually closed on December the 7th when the shareholders finally approved it. From $151.80 up to the final price of $156, that is a 2.77% difference. If you assume that the deal goes through, what that basically means is if you bought the shares on the date of the announcement and held them until the buyout was completed, you made a 2.77% return on 3 months of having your money in this stock. That annualizes out to about 11% per year. And so when I did the math on ATVI at the price earlier today, this 16% return over 18 months annualizes out to about the same. It actually is 2.66% per quarter, which comes out to about an annualized return of about 11%. So, why would it be so attractive to just buy ATVI right now and make that 16% return? Well, it takes patience. As I showed you, there's a chance that it could not go through. And the stock market last year returned, I believe, somewhere over 20%. These are all factors that go into the risk premium that makes up this arbitrage. And so the fact that you can have a quarterly return, potentially, or an annualized return of 11% makes this merger arbitrage very similar to recent ones like the one in HRC. So that's the trade. The trade is basically this deal will go through, and at the closing, you, if you own ATVI shares, will receive the $95 per share. So buying them now would give you that kind of return. That's the trade on this merger arbitrage opportunity. The risk, again, is that the deal doesn't go through, but at that point, you're left with Activision Blizzard shares, and the company is off to do whatever it is that they want to do. Hopefully, make better games. So that's the video explaining this trade, this opportunity. So hope you guys trade it wisely. We'll see you in the next one.